Blockchains have a flaw. They are completely blind to the real world. A smart contract can move billions of dollars, but it has no idea what the price of anything actually is. It cannot check interest rates, verify a payment cleared, or confirm a shipment arrived. Chainlink solved this problem. And now Swift, Mastercard, the Central Bank of Brazil, and over 70 blockchains depend on it. Today we're breaking down Chainlink, how its Oracle network actually works, fixed supply tokenomics tied to real fees, trillion-dollar institutional partnerships, and the exact millionaire math to retire as a millionaire holding Link. If you're watching but not subscribed, hit that subscribe button, guys. It helps us bring you more breakdowns like this. So let's get into it. This is not a financial advice, always do your own research. Chainlink was founded in 2017 by Sergey Nazarov and Steve Ellis. But to understand why Chainlink exists, you first need to understand a fatal limitation of blockchains. They are blind. A smart contract can move money, but it has no idea what's happening in the real world. It doesn't know the price of Ethereum. It doesn't know interest rates. It doesn't know whether a shipment arrived, a game ended, or a payment actually cleared. So if a smart contract cannot access real-world data, it can't power real finance. This is known as the Oracle problem. And for years, it was the biggest obstacle preventing blockchains from being used beyond simple token transfers. Chainlink was created to solve that exact problem. Instead of trusting a single data source, Chainlink uses a network of independent Oracle nodes. Each node pulls data from different real-world sources, exchanges, APIs, financial data providers, and then aggregates and verifies that data before delivering it to a smart contract. When you see Aave assessing loan collateral or Synthetics pricing synthetic assets, they are using Chainlink's decentralized Oracle network to feed reliable, real-time price data into those smart contracts. Because without that, DeFi cannot function. Chainlink launched its mainnet on Ethereum in 2019, and instead of marketing itself to retail traders, it quietly became infrastructure. The project isn't a blockchain competing for users. It's the data layer that blockchains actually depend on. And that's why it doesn't look flashy, and that's why it matters. Now, let's talk tokenomics, because this is where things get interesting. Chainlink has a fixed max supply of 1 billion tokens. No inflation, no new tokens ever get minted. This is huge because it means the supply side is completely predictable. Here's how the tokens were initially distributed. 35% went to public sales during their 2017 ICO, which raised $32 million at 9 cents per token. Another 35% was allocated to node operators and ecosystem incentives, basically paying the people who run the infrastructure. The final 30% went to the company for development. Now, I know what you're thinking. 30% to the team sounds like a lot, but here's the reality. Unlike many projects that dumped tokens on retail, Chainlink's team has been incredibly disciplined. They've only sold about 5% of their holdings over the last 3 years. That's a sign they're in this for the long haul. Additionally, there's no staking inflation like you see with proof-of-stake chains. Instead, Chainlink introduced staking in version 0.2, which launched in November 2023. The staking doesn't mint new tokens. Instead, rewards come from network fees and future user payments. Here's the critical part. As more institutions use Chainlink, those fees get converted to Link tokens and stored in what they call the Chainlink reserve. This creates real buy pressure from actual usage. It's one of the few crypto projects where token value is directly tied to real-world demand. Let's examine the performance and partnerships, because this is an area where Chainlink absolutely dominates. The network has enabled over $27 trillion in transaction value since launch. That's more than most countries' GDP if you think about it. The partnership list reads like a who's who of global finance too. We're talking Swift, the messaging system used by 11,000 plus banks worldwide. We're talking the Central Bank of Brazil, using Chainlink for their digital real pilot. Swift, Euroclear, Mastercard, Fidelity International, UBS. These aren't crypto-native companies. These are the backbone of traditional finance. Moreover, the Chainlink Cross-Chain Interoperability Protocol, or CCIP, is now live on over 70 blockchains, including Ethereum, Solana, Avalanche, and Arbitrum. This is the layer that lets different blockchains talk to each other securely. As tokenized assets spread across multiple chains, CCIP becomes the rails everything runs on. It's about time we address the topic of decentralization too, when it comes to Chainlink, and take a look at some other risks. The project has faced criticisms, indeed, over the years about being too centralized. So let's be honest about what's up here. First, whale concentration. Node operators hold about 35% of supply. The team owns approximately 25%, and exchanges hold roughly 16%. That means about 76% of tokens are in relatively few hands. For a decentralized protocol, that should be concerning. However, there's some context. Unlike governance tokens where whales can control protocol decisions, Link has no on-chain governance. The team explicitly chose this model to avoid governance attacks. You cannot vote to change Chainlink with your tokens. The development remains with the core team and node operators. Moving on to the regulatory risk now, which is lower than most crypto projects, because Chainlink isn't marketed as an investment and serves actual infrastructure purposes. It's largely avoided SEC scrutiny. In 2024, when the SEC brought 583 enforcement actions totaling $8.2 billion in penalties, Chainlink actually was not touched at all. Still, future regulations could impact tokenomics, so be wary of that, guys. On a different note, competition is heating up. For instance, Pith Network, built on Solana, offers ultra-low latency data feeds and has secured over 100 partnerships. Band Protocol provides similar Oracle services across multiple chains too. API 3 offers first-party data directly from providers. These projects are nimble and specialized. But here's Chainlink's strength. It was first. It's battle-tested and it has brand trust. In crypto, especially when securing billions in value, trust is everything. Chainlink's track record of 0 major exploits over 7 and more than that years is actually unmatched. Newer oracles might be faster or cheaper, but they don't have that security reputation just yet. Alright, time for the fun part now. The price history and the millionaire math. Link started around 17 cents in 2017. If you bought at launch and held through the peak, you saw over 3,000% return. But right now, the price is at a 74% discount. It's trading at around $12.50 with a market cap of about $9 billion. Now, let's run the 3 scenarios for Chainlink's future price and then calculate exactly how many tokens you would need to hit $1 million. First, the so-called bear case scenario. If the price makes a new all-time high, it will most likely hit $69. That would give us an almost 5.5x on our money. So we would need to buy 14,500 Link tokens, which would be an investment of $184,000. Second is the base case scenario. Let's say the price reaches $130. This would grant us over 10x return after we've bought 7.7 thousand Link tokens for $97,000 at today's prices. And ultimately, the bull case is if Chainlink reaches the market cap of BNB at its all-time high at $180 billion. The price of a single Link token then would be $260. That's more than 20x return on investment. To reach that 1 million goal, we would need to buy about 3,900 Link tokens, costing us $48,000. And now, if you want to go for one of these scenarios in practice, and you're looking for a simple, centralized exchange to trade the Link token on, CoinEx is my recommendation for you. CoinEx is currently giving new users $25 when they register using the link in this video's description. This is a seasoned crypto exchange with nearly a decade of experience, where you can buy Link along with over 1,000 other spot tokens. If you like taking on some risk for potentially higher returns, you can also use their leverage trading features. The platform is very user-friendly, so sign up to CoinEx through the link in the description, start trading, and claim your free $25 today. Now that you've seen the millionaire math, the natural follow-up question is, what could realistically push Link toward those scenarios? Well, it boils down to big money flowing in, and Chainlink is already seeing that momentum. Take the Grayscale Chainlink ETF, which launched in November 2025 and pulled in $41 million on day one. This is making Link accessible through traditional brokers, boosting liquidity for everyone, and retail gets tighter spreads while big funds pile in without touching crypto exchanges. But here's where it gets really exciting. In June 2025, Chainlink announced a partnership with Mastercard that gives 3.5 billion cardholders direct access to buying crypto on-chain. Think about that number, guys. 3.5 billion people can now convert their fiat currency to crypto using the card already in their wallet. So when people ask what could be the catalyst that propels Link towards those high valuations that I gave you earlier, this is the answer. Chainlink isn't waiting for speculation. It's positioning itself exactly where institutional money and everyday users enter the market. Ultimately, Chainlink isn't a lottery ticket. It's infrastructure. And if this thesis plays out, the upside won't come from hype, but rather from slow, relentless adoption while most people are still distracted by noise. Whether you decide to buy Link or not, at least now you understand why it matters and what the math actually looks like. See, if this analysis helped you think about and understand Chainlink more clearly, then hit the like button, because it tells the algorithm that this content is actually worth pushing. Also, I would encourage you to share this video with someone who's still making the same old mistake of chasing memes instead of fundamentals. And if you want more deep dives like this, then subscribe to the airdrops.com channel. I'll see you in the next one. Ciao.